As you know, the purpose of the retained earning account is to show all of the net income that business has earned over its life, excluding any income that has been distributed to shareholder. What we haven't yet discussed, however, is how many amount actually get into the retained earnings account. In addition, you know that point of using revenue and expense account is to track the operation of a business over a period of time. But we have not yet discussed how, for example, this year's rent expense is separated from last year's rent expense, given that both are recorded in the same account. The accounting close process is the answer to both of those questions. At the end of each accounting period, all of the temporary accounts like revenue accounts, expense account, gains account, and loss accounts are zeroed out, with the income summary account being used for the other half of the journal entry. The purpose of zeroing out the balance in each of these accounts is to give them a fresh start for the next accounting period. That is the idea, to ensure that at any given time, a revenue account will show the amount of revenue that has been earned so far in that period, without including amount from prior period. After all of the temporary account have been zeroed out, the income summary account will have a credit balance equal to the firm's net income for the period, or a debit balance equal to the firm's net loss. The balance is then zeroed out and transferred to retained earning. Let's take a look at an example. Prior to the year-end close process, ABC Consulting trial balance is like this. To close out their book of the year for the year, ABC accountants will make the following journal entries. After all of the temporary account having closed, the income summary account will have a credit balance of $55,000, which represents the firm's $55,000 net income over the period. ABC's accountant would then make this entry to close out the income summary account to retain earning. So here's a summary. At the end of each accounting period, closing journal entries are made out to zero out the balance in revenue, expense, gains, and loss accounts, with an income summary account being used for the other half of each closing journal entry. After all the income statement account having zeroed out, the income summary account will have a balance equal to the firm's net income or loss for the period. A journal entry is then made to transfer this balance into the retained earnings account.